Welcome to the quarterly MIGO update. We had a good start to the year with the share price hitting all-time highs and briefly trading at a premium in early January. Markets, however, have been far from smooth sailing in 2026, contending with a software sell-off due to AI fears and more recently the war in Iran, reminiscent of Ukraine 2022 minus the starting point of a low interest rate backdrop. Despite a late quarter rally, MIGO held up well against broader markets. For the quarter, our NAV was down just 0.2%, compared with the MSCI Country World Index down 1.4% and the FTSE Investment Companies Index down 3.7%. In relative terms, March was even stronger. MIGO's NAV down 3.1% versus down 5.4% for the World Index and down 7.6% for the FTSE Investment Companies Index. MIGO's move away from equity trusts has helped in this sell-off, meaning the portfolio now has much less market beta than it did in previous crises. Our renewable holdings also provide some help for exposure to higher power prices. Rising inflation and fewer rate cuts remain headwinds, but we still see strong idiosyncratic catalysts across the portfolio, and we're ready to add where weakness looks unwarranted. Baker Steel Resources was the standout performer, helped by a strong rise in metals prices and progress on refinancing its thermal coal mine in Australia. VH Global Energy Infrastructure also benefited from early interest in its assets following the movement to wind down, and we still think there is very strong, compelling asymmetric upside there. We also saw positive corporate activity in Augmentum FinTech, where an M&A bid delivered a meaningful uplift. Chrysalis was weaker, mainly due to discount widening, despite the market's concerns about AI disruption being, in our view, overstated. We added to the position during the quarter and still see attractive upside from here. By contrast, we exited from Sherborne Investments after the Navient results pushed back a key catalyst that was critical to our investment case, namely the expected spin-out of their fintech business Earnest. We do not have material direct exposure to software in our portfolio. Our listed priority holdings, Pantheon and Harbourvest, do have software as their largest sector exposure, but they're far more diversified than sector specialists like HG Capital, which has been hit particularly hard. We also think the market has been far too blunt in its view on software and failing to distinguish between companies with proprietary data embedded in regulatory workflows and those that are really just interfaces or aggregators of data. Although higher interest rates and inflation will be a headwind, more difficult markets are where MIGO often comes into its own. We have a portfolio that has low underlying equity market exposure, carefully constructed to benefit from idiosyncratic events and heightened corporate activity in the investment trust sector. We believe MIGO is particularly well suited to navigate successfully the current market backdrop and to remind investors of the value of MIGO's place in their portfolios.